Here's a scenario that I think a lot of people quietly live in. You've been saving for retirement for years, maybe even decades. You contribute every month. You've got some mix of stocks and bonds, maybe a 401k through work and a Roth IRA on the side. And every few months, you open up the app, you look at the number, and you feel something. But you're not sure what exactly, because there's no clear scoreboard. Nobody pulls you aside and says, hey, actually, you're doing great. Or worse, hey, you need to change course immediately. You're just kind of out there doing the thing, hoping the thing is the right thing. And the comparison trap doesn't really help. You might see some headline that says, average American has $87,000 saved for retirement. And you think, okay, I have more than that, so I'm fine. But then you see another one that says, you need $1.4 million to retire comfortably. And suddenly, $87,000 sounds like a cruel joke. So now you've got two wildly different data points and absolutely no idea where you actually stand. My name is Adalyn, and honestly, I spend probably too much time thinking about money. Not just the numbers, but the psychology behind it, the way people relate to their future selves, and why some people arrive at retirement with abundance and options, while others get there and realize the math never quite worked out the way they hoped. I've been deep in this stuff for years, and one of the things that keeps coming up over and over again is that most people are measuring the wrong things. They're looking at the scoreboard wrong. They think retirement readiness is just about the total balance, and so they either feel falsely confident or unnecessarily panicked, and both of those things can quietly wreck a financial future. So, what I want to do today is walk you through 3 signs, real, meaningful signs, that your retirement portfolio is genuinely ahead of where most people are. Not in a way that makes you feel smug or complacent, but in a way that helps you understand what actually matters. Because some of these signs have nothing to do with how big your number is. And that, honestly, surprises most people when they first hear it. Let's get into it. Okay, so this sounds almost too simple, right? But stick with me here, because there's a really important distinction buried inside this one that most people completely miss. There is a version of saving for retirement that is basically just holding money, parking it, keeping it safe. A lot of people have their retirement accounts set up. They've got the 401k, they're contributing every paycheck. But if you looked inside the account, you'd find that the money is sitting in something like a money market fund or a stable value fund, or sometimes, I kid you not, just cash. And the person doesn't even know because they set it up years ago and never really looked closely. This is shockingly common. One study found that a meaningful percentage of 401k participants had never changed their default investment option. And in some plans, the default was extremely conservative, designed to not lose money in the short term, but also designed to not really grow it either. And here's why it matters so much. Compound growth, real compound growth, the kind that actually builds wealth over decades, only happens when your money's out there working, when it's invested in assets that have the potential to grow. Broad market index funds, a diversified mix of equities and bonds appropriate for your timeline, target date funds that automatically shift as you get older. The difference between someone who has $100,000 sitting in cash in their 401k for 20 years and someone who has that same $100,000 invested in a low-cost index fund over 20 years is enormous. We're talking potentially hundreds of thousands of dollars in wealth from the same starting amount, just from the decision to actually be invested versus technically in an account. So, sign number 1 that you're ahead of most people, you're actually invested. Your money is in real growth-oriented assets. You understand what's inside your accounts. And not every holding necessarily, but the broad shape of it. You're not just saving, you're investing. And if you're reading this going, I actually don't know what my money is in right now, that's not a reason to panic. That's just a reason to spend 20 minutes this week looking. Open the account, find the holding section, and just see. It's one of the highest ROI uses of 20 minutes you'll ever find. There's also a related thing here that I want to mention, which is the difference between being invested and being well invested. Being invested means your money is in growth assets. Being well invested means you're not paying enormous fees to do it. Expense ratios matter enormously over long periods. A fund charging 1% per year versus one charging 0.05% per year sounds like a rounding error, but over 30 years across a large portfolio, that difference can cost you six figures. Actively managed funds with high expense ratios almost never outperform their low-cost index fund counterparts over the long run. And that's not my opinion, that's basically the consensus of decades of data. So, actually invested in low-cost, diversified funds in accounts you understand, that's the baseline. And a huge chunk of people haven't cleared this bar. This one is a little more nuanced, but it's honestly one of the most powerful indicators of long-term retirement health that nobody talks about. Here's the thing about money and lifestyle. When people get a raise, and I mean when most people get a raise, their spending tends to rise to match it. This isn't a character flaw, it's basically a deeply human tendency. You make more, you feel like you've earned more comfort, maybe you upgrade the car, move to a slightly nicer apartment, eat out more frequently. Economists have a name for this, lifestyle inflation, and it's probably one of the single biggest quiet killers of retirement security that exists. Because here's what it means in practice. If you're making $60,000 a year and saving 10%, you're saving $6,000 a year. Then you get a raise to $75,000, a really meaningful 25% jump in income, but your spending also jumped because you upgraded a few things, and now you're spending $68,000 a year instead of $54,000. Your savings rate actually dropped. You have more money coming in and somehow less going toward your future. Most people, if you ask them, would say they're saving more since they got the raise. They're not keeping precise track. And this is part of why savings rate is such a powerful metric. It cuts through all of that noise. It tells you the true ratio of money going toward my future versus money going toward my present. Sign number 2 that your portfolio is ahead of most people is that your savings rate has kept pace with your income growth.
Every time your income went up, you captured a meaningful portion of that increase and directed it toward retirement before it had a chance to inflate your lifestyle. Your savings rate is at least 15% of your gross income and ideally higher. If you're north of 20%, you're honestly in rarefied territory. This is where the concept of paying yourself first is actually more than just a catchphrase. It means automating your savings increases. It means when you get a raise, logging into your 401k the same week and bumping your contribution percentage before you've mentally allocated that money anywhere else. It means treating your retirement contribution like a fixed expense, like rent, like a utility bill, rather than something you do with whatever's left. And I'll be real with you, this is hard, especially in your 30s and 40s, which are often the years where life gets simultaneously more expensive and more tempting. Kids, mortgages, travel, experiences, better cars, nicer restaurants. The present is incredibly loud, and the future is very quiet. Your 65-year-old self has no lobbying power. They can't text you and say, hey, please don't spend that money on the thing. You just have to kind of represent them yourself. The people who are ahead in retirement savings are almost always the people who figured out some version of this. They didn't necessarily earn dramatically more than their peers, they just captured more of what they earned. And over 30 years, that gap compounds into something extraordinary. Okay, this is the one where people's eyes either light up or glaze over, and I'm going to beg you to stay with me here because this might be the most important thing in this entire video. Most people think about retirement investing in terms of average annual returns. Like, the stock market averages around 7% per year after inflation. So if I have $1 million, I can withdraw 7% a year and be fine. This logic sounds reasonable. It is also, unfortunately, incomplete in a way that can completely derail a retirement. The problem is called sequence of returns risk, and it basically means this. The order in which you experience good years and bad years matters enormously, especially in the years just before and just after you retire. Let me give you a simple picture. Imagine two people. Both retire with $1 million, both experience the exact same average return over their 30-year retirement, let's say 6% per year. But person A experiences strong returns in the early years of retirement, followed by a downturn later. Person B experiences the opposite. They hit a major market downturn in their first few years of retirement, followed by strong returns later. Same average, wildly different outcomes. Person A is fine. Person B may run out of money entirely, even with the same average return, because the early losses happened while they were making withdrawals. Every dollar withdrawn during a down market is a dollar that doesn't participate in the eventual recovery. This is not a theoretical concern. People who retired in 2000 and planned based on average historical returns got absolutely blindsided. Markets dropped significantly in 2001 and 2002, right at the beginning of their withdrawal phase. Many of them had to dramatically reduce spending or return to work, not because they made bad investment decisions, but because of timing. The market didn't care when they retired. So, sign number 3 that your portfolio is ahead of most people, you have thought about this, or you have a plan that accounts for this. You're not just looking at your projected balance and assuming a straight line return. You've thought about things like a bucket strategy, where you keep 1 to 2 years of living expenses in cash or very low-risk assets, so that if the market tanks right as you retire, you can live off the cash bucket while you wait for the investments to recover. You're not forced to sell during a downturn. A flexible withdrawal strategy where you understand that in bad market years, you pull back spending a little, and in good years, you can spend a bit more. This isn't about deprivation, it's about giving your portfolio the oxygen it needs to recover. A bond tent, which sounds incredibly technical, but is actually a fairly elegant idea. In the years approaching and just after retirement, you temporarily increase your bond allocation as a buffer against early market downturns, then gradually reduce it back as you move deeper into retirement and the sequence risk window narrows. None of these strategies are perfect, but having thought about this at all, having a plan that acknowledges the reality of market timing risk, puts you so far ahead of the average person who is essentially planning based on a spreadsheet that assumes every year will return the average. Life doesn't work like that. Markets don't work like that. And the meta point here is something I think about a lot. The difference between people who have financial security and people who don't often isn't intelligence. It's not income. It's the willingness to sit with complexity for long enough to actually understand it. Most people know vaguely that they should be saving more. Far fewer people understand sequence of returns risk well enough to plan around it. The people who do are almost always the ones who end up fine. I don't want to be dramatic about this, but I do want to be honest. The reason most people get retirement planning wrong isn't laziness or stupidity. It's that the financial services industry has had for decades a vested interest in making this stuff seem more complicated than it needs to be. So you'll pay someone to manage it for you. And separately, the culture around money in most households and schools doesn't exactly set people up with these concepts early. So when I say most get this wrong, I mean most people are measuring the wrong things, optimizing for the wrong signals, and not thinking deeply enough about the mechanics of the withdrawal phase. That's a fixable problem, and recognizing it is the first step. So let's land this plane. 3 signs your retirement portfolio is way ahead of most people. 1, your money is actually invested in real growth-oriented low-cost assets, not just parked in an account and slowly losing ground to inflation. 2, your savings rate has kept pace with or outrun your income growth, which means lifestyle inflation hasn't quietly eaten the progress you've worked hard to make. And 3, you have a plan that accounts for sequence of returns risk. You're not planning based on averages, you understand that timing matters, and you have some version of a strategy to protect yourself if the market decides to have a bad few years right when you're trying to retire. And here's the thing I want to leave you with. None of this requires you to be a financial genius. None of it requires a finance degree, or a complicated spreadsheet, or a fancy wealth management firm charging you 1% of your assets annually. What it requires is attention, a willingness to actually look at your accounts and understand what's in them, and a commitment to prioritizing your future self even when the present is loud and demanding. Your 65-year-old self is counting on the decisions you make right now. And I know that sounds like a cliche, the future self thing, but when I actually think about it, really sit with it, it stops feeling like a cliche and starts feeling like a genuine responsibility. The person you're going to be in 20 or 30 years is completely dependent on the choices the current version of you makes this month, this year, this decade. The good news is, if you watch this far, you're already doing something most people don't. You're paying attention. You're taking it seriously. That's not nothing. That's actually where it all starts. So go check your allocation, recalculate your savings rate, spend 30 minutes reading about sequence of returns risk, not because you need to panic, but because knowing these things, really knowing them, is genuinely one of the most powerful things you can do for yourself.